Okay, so the last stock on this list is GE. Now, I feel like I'm looking at GE just out of morbid curiosity, but if we start by looking at the last 10 years of GE's earnings, we can see a company that is really struggling. They've been profitable just twice between today and 2015. Revenue is continuing to decline, but a lot of that has to do with the turnaround plan being implemented. When Larry Culp took over the business in 2018, the number one goal was to improve the financial position of the company. The focus is on getting rid of businesses that just aren't contributing as much, and then to reduce GE's overall debt situation. The second goal is to work towards improving their financial efficiency, which they expect to achieve through cutting costs and working to improve their services and products. Well, in the last earnings report, GE announced that it did beat the free cash flow expectations, but revenue again did fall short of forecasts, with supply chain issues blamed as the cause. Now, GE has recently changed a lot about their business. Specifically, they will spin off GE Healthcare, but retain about a 20% stake, and GE Power and Energy and Digital will be spun off together in 2024, and the remaining GE company will be focused on aviation. That still leaves a lot of questions about who's getting the debt load, so we're going to have to see how that ends up shaking out. But when we look at how this quarter compares to the rest of their earnings, we can see that this really wasn't a whole lot of profit compared to what they were doing in the past. And since this company is in the middle of a big turnaround plan, I'm not really sure how much it matters anyway. Now, unfortunately, again, like Robinhood, I am still waiting for GE's 10Q to upload, so I am definitely missing a lot of information. However, I was able to find some interesting information anyways. Now, if we look at the segments broken down by the information we have so far, we can see that clearly aviation is the biggest revenue generator, and that healthcare has been surprisingly pretty steady and profitable for them. Now, keep in mind that power, renewable, and healthcare are all going to be spun off, and on top of that, the GE Capital unit is also in the process of closing out and being merged into the rest of their business, which is going to happen after GE sells their aircraft leasing business for $24 billion in cash. So we're looking at the forecasted earnings for GE. The current projections are for them to grow to about $90 billion in revenue and $7 billion in profits. But if we look over at revenue growth, we can see the business has mostly gone sideways. So for fun, let's value them with a minus 2% growth rate for the bottom end range and 2% growth for the top end of the range. That gives us a fair PE value between 7 and 10. Now, if we look at the valuation chart, this still puts GE fairly expensive with a fair value between 46 and 66 by 2024. The current forward PE ratio by 2024 is 13, so I do think things have to improve a lot for this company to justify the current price of $92 per share. Now, that clip was a part of a much larger video that I did covering about 6 stocks, so if you want to check out the full thing, make sure you check it out right over here. And as always, thanks for watching.